Hi guys again, we're going to finish our work with this video on chapter 8, which is about accounting for sales returns and purchase returns. This video purely focuses on sales returns. So if you have not watched the video of purchase returns, I would encourage you to watch that one first because it goes into a little bit of a theory and describes what a credit note is, which we won't go into today, so hopefully this will be a relatively short video. If we have a successful lesson and you follow this up by updating your notes and doing textbook exercises, you should be able to leave this unit being able to define what a sales return is. You should be able to record a sales return in inventory cards, general journals, and general ledgers. And you should be able to identify the effect of a sales return on the accounting equation. Making your notes, doing your textbook exercises, you'll have a successful unit and you will have recorded sales returns in these inventory cards using both identify cost and FIFO methods and recorded the sales returns in journals and ledgers. So what is a sales return? Sales return, and the heading is incorrect, I'll update that. A sales return is a return of goods by a customer. That customer in our course is an accounts receivable, so it is a credit customer to a business. So what does that mean in simple language? We as the business have sold something, sold inventory to a credit customer. We created an accounts receivable because we have an asset. That business has returned, that customer has returned it to us because they are unhappy. And the original video on purchase returns said they could return it because it's faulty, the wrong size, the wrong color, late, any reason whatsoever. If we write a credit note and accept that return, we have a sales return. Here is an example. We as a business have sold 3 units for $200 each, and they cost us $100 with also a 100% markup. And we did that on June 5 using an invoice. The invoice gives us a hint, well not a hint, tells us that it is a credit transaction. How would we record this? We would have 5 elements, 5 accounts to impact because it's a sale. Our accounts receivable has gone up. We have an asset called accounts receivable. An asset going up is a debit. Where did we get the $660? Because we have sold 3 of them for $200 each, and there is also GST associated with this. $20 of GST for each of these units. We then have revenue of $600 because we don't get to count the GST as revenue, but we've sold 3 for $200, so we have sales of $600. Sales is revenue. Revenue only ever goes up, and revenue going up is a credit. We have GST here. It doesn't specifically says that, but we know all transactions have GST, and GST here has gone up by $60 because there is $20 of GST on each unit. 20 times 3 is 60. We have received GST in this transaction. That means our liability to the government has gone up. A liability going up is a credit. We always consider GST to be a liability. We have not made $600 of profit. We have made, and you should be able to work this out, $100 of profit for each unit, 200 minus 100, because the cost price is 100. So we have an expense of inventory leaving our building. $300 of inventory has left the building. Inventory is an asset that goes down. Inventory going down as an asset is a credit. Our expense is cost of sales, which is a debit because expenses only ever go up, and expenses going up is a debit. Hopefully that makes sense. If that transaction recording those 5 is something that you're still struggling with, then we need to do a little bit of work, and we might do an individual class to work through that. What we are worried about is not this today. We are worried about if one is returned. let's say, for example, 1 unit is returned on June 6, and that is because of a source document called a credit note. We would write this source document because we are receiving the goods. Because there is a return, we have to remove any trace of this part of the sale of our accounting records. We don't get to say that unit is a sale anymore. How do we do that? We reverse that 1 unit. How do we reverse something in accounting with debits and credits? If we recorded it as a credit, we will do a debit. So if we look back on here, for example, we have accounts receivable as a debit. If you look at how we reverse it, our accounts receivable will be a credit. Inventory hasn't left our building. We have another where inventory has increased because of this return, because inventory has been returned back to us. Inventory going up is a debit. Our expenses have reduced because our sales have also reduced. So these are our 5 elements that we need to record, and you'll see that they are the exact opposite of what we would have recorded for a credit sale. The one difference here as well is, hopefully you've seen it, one account is different. Hopefully you've noticed we have not reversed our sales with a debit on sales. We've called it something very different here. We have called it sales return. So let's use our example and think about what our numbers are going to be for our debits and credits here. 1 unit has been returned. You might remember that 1 unit cost us $100 and we sold it for $200. So our accounts receivable is going to go down by $220. Accounts receivable, being an asset going down, is a credit, $220, because that customer will no longer pay us the $200 or the GST on that transaction. The GST is a debit because we don't have to pay that part to the government anymore. It's just been reversed. We have $100 more of inventory now in our building. Why is it $100? Because the cost price of that inventory was $100. And our expense has been reversed as well. You will see the sales return here is a debit, and this is probably where the only time you start to think of revenue or expenses going down. So you can start to think of a sales return as revenue going down, and that's when we get a debit. You would do some sort of narration. Customer returned goods incorrect color. Credit notes, you've given me the reason why there is an issue. You've told me it's been returned. If you know the type of good, it's probably important here. So for example, customer returned 1 hammer. It's the incorrect color. And that's how you'd record it. It's a pretty complicated transaction. You might have to slow that down, work through with your slides open, maybe look at your textbook, maybe do one of the textbook answers, open book with the solutions to work through. But all we are doing is reversing our sale for the amount that has been reversed. The thing I want you to think about is, why do you think that we have a separate ledger called sales return? Why don't we just reduce sales? I'll hold that with you and we'll just point that out probably in our last slide. This is a pretty messy slide. We are hopefully becoming experts by now of picking up our general journals and posting them into our general ledgers. I'm not going to go through this in heaps of detail. These would be your posting of your general ledgers, from your general journal to your general ledger, using your knowledge of cross-referencing. If you are still confused by that, this is a complicated one. We can do a personal lesson to go through that. the important bit to remember here is we're going to have to update our inventory cards as well, because inventory, we record the ins and the outs. Sales return means we have more inventory. We have inventory coming into our building because of this return. So what do we say is the cost price of that? We might have different cost prices for that inventory because we're getting that from our suppliers at different cost. It is going to depend on whether we as a business are using FIFO, first in, first out, or identified cost. It will always be outlined in your question, and it's really one of the first things you need to highlight, note when you're reviewing the question. If it is identified cost, so we'll do the one on the right first, it should be easier. We should be able to know which one has been returned back to us, and all we then do is going to do our in at that price. So let's say, for example, the good that has been returned is, we know we cost us $80 when we bought it. The one that is returned now is $80. FIFO is a little bit different. We apply the reverse of FIFO. Instead of, that is, the last price used in the out column, so the most recent one sold, is the one that we assume has been returned. This means that the inventory card should be built in the order that the inventory was originally purchased. Again, that's a lot of text, maybe a bit confusing like that, so let's go through an example of FIFO. In this case, one unit is returned by a customer on May 6. And you can see we have assumed in May 6 that the one that has been returned, so in the in column, cost price was $12. How did we work that out? Because the most recent good to be sold was the $12 here. Even though 8 was sold on the May the 3rd, remember we always go from oldest to most recent, the $12 ones are written last, so the one returned must have been that. So we now have gone from not 7 costing us $12 and having a value of 84, we have 8 at $12 with a value of 96. What if 4 units are returned? Becomes a bit more complicated. We can assume that we still use the principle that the most recently sold are the ones that have been returned. That's our principle that we have to apply. So the first ones we assume that were sold were the ones that were $3. So these are all coming back into our building. And we now have, because we have run out of our $12 ones after 3, the next ones that we sold were the $10 units. So one of them has come back. We will list like so. Why is the $10 one listed first? Because that is still the older stock, and FIFO says we list older stock before our newer stock. Again, that's a lot of information on a slide. Pause, have a look through it, maybe look back at your notes, and we can do personal lessons if that is confusing. So what is the impact on our accounting equation because of a sales return? Our assets are going to decrease. Yes, our inventory goes up because we have inventory returned to our business, but our accounts receivable decreases by a larger extent because we are selling something for more than what it cost. Our liabilities are going to decrease because our GST goes down because we don't have to pay what's been returned. And ultimately our business is worth less, so our owner's equity decreases because our sales go down because sales return goes up. That will make sense in the next slide, and our cost of sales goes down. How do we report these sales returns when in our income statement? We haven't done income statements later yet. Sales returns are reported separately in the income statement so the owner is alerted to potential problems and customer dissatisfaction with stock. This comes back to that question that I asked you, why do we have a sales return account? It's because the business should know if there are lots of returns. That suggests there is an issue with the business. So we report it as negative revenue. We deduct it from sales and it looks something like this. Sales, that's the amount from the sales account closed to profit and loss summary, and that will make sense in our next topic. Less sales returns, and that gives us our total sales or net sales. An example of this is in the top right of your screen, which is probably blocked by me, but in your actual slides, you'll be able to review that. Guys, hopefully that makes sense on sales returns. Obviously that not just watching the video will give you the understanding. Textbook exercises, your notes, and you will leave chapter 8 being an expert at recording purchase and sales returns.